Welcome back, traders. Jeff with OptionBoxer.com. And in the last video, we kind of went through and identified a trading opportunity, a hypothetical trading opportunity. And in this video, we're going to look at how to set up the actual trade. So the disclaimer is this example was selected for the demonstration provided below. These trade setups happen all the time and on every chart, but your results may vary. You should always do your own due diligence and your own research before making investment decisions, and or consult a registered financial advisor. This page is not a recommendation for you to buy or sell any securities, neither is this video, or attempt the information provided. It is for educational and entertainment purposes only. You are on your own out there. Okay, so like I said in the last video, we looked at Delta and found a potential trade we wanted to make. So now we got to look at setting up that trade. So to place a trade via Thinkorswim, which is the platform I use, there are many other platforms out there, but I typically only use Thinkorswim, sometimes Robinhood, but for the most part it's Thinkorswim. And Thinkorswim makes it fairly easy to set it up, but you've got some determinations you need to make, or some decisions you need to make. So you need to determine the expiration time frame. You need to determine the strategy you want to employ, determine the amount of capital to risk. You want to determine the strike prices that you'll use, either the strike price if you're buying a single contract, or strike prices if you're opening a spread trade. Determine a profit target and determine a loss target. These steps are a simplified version of a trading plan. So, determining these, you can be as detailed or as non-detailed as you want, is basically a trading plan. Most traders fail because they don't follow their plan throughout the trade. Once you've determined what your plan is for a trade, it's set in stone. Don't be the person that holds on to a losing position past your loss target with the hope it will rebound. If an adjustment is necessary, make it. If not, close the position and move on. I'll talk more about adjustments in different strategies, and I won't talk about them in this video series. Adjustments are more of a intermediate to advanced concept, and so they're not really recommended for the new options trader. But if you understand them and you feel confident making one, by all means, that's one of the big advantages to trading options, is you can adjust a position and potentially turn a loss into a winner. So we're going to determine the expiration time frame. There is no just set in stone rule. You just kind of have to determine how quickly you think a move will happen. So once you've decided how quickly, in this example, we believe that the move will happen in the near future. So we're going to trade the March 2016 expiration month, which is 31 days until expiration. So you can see here, I've determined at this point in time, now it's 2019 now, so back in 2016, for this hypothetical trade, I decided 31 days would be enough. To keep things simple, I'll be selecting a long call position only. In future videos, or in videos that I've already created, you can find different strategies and different techniques for using bull put spreads or bear call spreads, or any number of different strategies. You can also find a number of strategies here under the bullish strategies, bearish strategies, and neutral strategies. But for this video, we're just going to look at this long call right here, and let's see, strategies will be discussed in depth, which I've already just showed you. The anticipation is that the stock will move higher, and thus the option contract will increase in price. As a warning, volatility and time decay can cripple a long call option. Both will be discussed in relevant strategy pages. So that's discussed elsewhere, but just you should at least know about them. Time decay, as we discussed earlier, is referring to theta, where when you sell short an option spread, or an option, either a put or a call, time decay is actually working in your favor. As time goes by, you're actually gaining that theta. If you buy an option, however, theta is negative, and therefore every day that goes by, it works against you. So the decision is to buy a call option, determine the risk capital, As a general rule, I usually allocate 2% of my available capital to any one trade. For this example, I'll assume I have a trading account of 5,000. This site may not still exist, but if it does, it's a great resource, so feel free to look at that. It's mostly about stock trading, but it has a great section on money management. So 2% of 5,000 is $100 of capital to risk. So my decision is $100 of maximum risk. Now let's determine the strike price. Choosing the right strike price can be the difference in success or failure. And unfortunately, there isn't a stable rule to be applied in all circumstances. So for this example, I'm assuming a quick move higher in the share price. So good practice when selecting long options is to buy a call option with a 75 delta or better. I won't be covering the Greeks, but just be aware that the best strike price to select in this instance would be the one with the higher delta. Unfortunately, however, for this example, our 2% allocation is not enough to allow us to buy a 75 or better delta. So you're kind of stuck between a rock and a hard place. You have to either commit more capital, or you have to make a concession and buy something maybe out of the money. And this is where I talk about, do I want to increase the amount of capital at risk with the hope of a larger reward or a larger loss, of course, or do I simply want to select a strike that falls under my $100 of max risk? For this example, and what I feel is good practice in general, is to err on the side of caution and choose the option that protects your money. So that's what I would do in this situation. I would, if I thought Delta was going to improve in price, I would probably risk less and trade something that's maybe at the money or just out of the money. And in this case, that is close to as at the money as possible while still under my $100 of allowed risk. So you can see I have highlighted here. I'll pull it up so we can see it a little better. You can see for 97 cents, I'm going to buy the March 16 47 call option. So my profit target in this case, I decided to let my winner run, so I'll close if research suggests the trade will move against me. In reality and kind of in hindsight, looking at this decision, I think it's always good to set a profit target. So we don't have one in this video for this example, but in reality, you should always set a profit target. That's just good practice, I think. So, excuse me. So a loss target, of course, it's vital that you set a stop loss and stick to it. So this option contract is currently trading for 97 cents or $97 because one contract, as we talked about in an earlier video, gives us the right to buy 100 shares at the 47 strike price. For this example, I only want to risk 20% of my $100. So this kind of falls back into money management, but this will help us determine our stop loss. So of course, 100 times 20% is $20. And that means that at any point over the course of this trade, if this 97 cents becomes 77 cents, I'll simply close the position and walk away. You can also set an order with your broker to, like we talked about with the limit and the stop loss orders or the stop limit orders. You can also set a stop limit order to trigger, at let's say 87 cents. 87 cents, but you're looking to get it for 77 cents. However you set it up is up to you, but you can certainly do that and have that on the books. That way, if you're not able to stare at the computer screen as it gets down to these levels, your order's already on the books and it'll process without you having to do anything more. So the decision is to close if it falls below 77 cents. So recapping what we just looked at there, the March 2016 expiration month was the contract month we were going to trade. That has 31 days till expiration. We're going to buy a call option and we're going to risk $100 is our maximum risk. We're going to buy the 47 call option. I guess I mentioned that twice. And let winners run, so close if research suggests the trade will move against us. And we're going to close if the call is trading below 77 cents. All right, so next video, we're going to look at placing the trade.